Hello and welcome to the channel, everyone. Today we are going to be discussing how insurance companies make money. There are several key components to how insurance companies make money, and we will be discussing all of them today in depth. They include underwriting profit, investments, diversification, and statistics. So let's get to it. One of the major ways insurance companies can achieve profit is an underwriting profit. This is charging more than what they pay out in benefits. It is their profit margin. In insurance terminology, this is expressed in the combined ratio. This is total losses and expenses divided by earned premiums. Anything below 100% indicates profit. Anything above 100% indicates a loss. Now, as I said earlier, this is the way they can make money. A fun fact is that US auto insurance companies from 2008 to 2017 did not report a combined ratio below 100%, meaning that they had underwriting losses for this entire time, indicating that they had no profit. There was definitely a lot of profit, they just generated it by other means. The next way, and perhaps most important method that insurance companies generate profit, is via their investments. The nature of insurance, where an insurance company sells a product and then expects to pay out on that product, if they do pay out, is sometime down the road. In the meantime, the insurance company is free to invest that money and generate a return until they have to make a payout. Insurance companies generally tend to generate consistent long-term returns on their investments. They match the duration of their investments to their liabilities. That is, they will choose to invest in something they expect to last, say, 5 years, if they expect to make a payout in 5 years. And then they generate profit by getting spread on the assets and liabilities that they have, meaning they make a little bit more on their investment than they expect to pay out. Insurance companies tend to invest heavily in bonds and fixed income products, and to a lesser extent, residential mortgages, commercial mortgage loans, stocks, private equity, and derivatives. And before we move on to the rest of the video featuring diversification and statistics, it is time for a shameless plug. If you're enjoying the video today or you found it useful, please hit that like button and consider subscribing to the channel. We would greatly appreciate it and it would help us out. As always, if you have any comments, questions, concerns, or requests for other topics, please go ahead and put those down in the comments section. Now let's get on to the rest of the video. The next important area for insurance company profit is diversification. Diversification allows insurance companies to have negative times for some products or in some areas, while other products balance out those negatives over time. Insurance companies have multiple sources of diversification, including product diversification, such as property and casualty insurance, life insurance, health insurance, and even diversification within one sector of insurance, say in property casualty. They can have home, auto, flood, or fire insurance inside that one sector. Additionally, insurance companies can choose geographic diversification. This is across different states or areas or countries. It can help to avoid or offset natural disasters, differing lifestyles, or anything that might be different with insured individuals in different areas. Additionally, insurance companies can target customer diversification. They can choose to target individuals, companies, or groupings. This diversification helps these insurance companies weather difficult times across time and weigh it out with good times across different product lines. The final piece, which comes into play allowing insurance companies to remain profitable, is statistics. We hit on it a little bit earlier when we talked about the nature of insurance, but perhaps one of the most important things for insurers is the law of large numbers. While insurance companies do tend to insure negative outcomes for individuals, the law of large numbers states that if you have a large enough grouping of individuals, something that is of a low chance will only happen to a small number of those individuals. So while insurance companies might have a big payout, if they have a very large number of customers, that one payout doesn't get noticed as much. And this is their key to generating profit while insuring against bad events. Insurance companies are also very, very good at statistically analyzing morbidity and mortality, or the event that there are going to be claims among their product holders. A final piece, which somewhat touches on statistics, is cash value cancellations. Some buyers will cancel their contracts or stop payment on an insurance contract, and they won't seek to recoup that money, or it might be written into their contract that they can't get money back if they cancel during a certain time period. This is a small way that insurance companies can make money, but it is some money that comes into insurance companies. And with that, we have reached the end of the video today. So thank you for watching. If you liked the video, please go ahead and consider leaving a like and subscribe to the channel for more content. As always, if you have any questions, comments, concerns, or requests for other topics, please go ahead and put those down in the comments section. So thank you once again for watching, and we'll see you next time.